today's generation doesn't even know what inflation is compared to what we know inflation to be from the 80s and 90s. And we don't want to have a repeat of that, of course. But the reality is that I am very pleased to see what they're doing with these rate pauses, because I think that the job is over. I don't think that they need to continue to raise rates on us.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to and watching the Financial Survival Network. I'm your host, Kerry Lutz. It's 12/13/23. So we get the PPI numbers out. Inflation is out. Everything is looking good. What's the Fed going to do? Matthew Johnson with us now from Johnson Wealth and Income Management. And, well, you find him at johnsonwim.com. If you got any questions for him or myself, kl@kerrylutz.com is the email address. So, Matthew, great to have you back on. What are you making here of the latest numbers? CPI, PPI, personal consumption expenditures, all of that good stuff. What do you think?
Well, it's great to be back on the program. Thanks for having me again, Kerry. There is just a lot of information to kind of unpack over the course of the last couple of weeks. So I guess we'll begin with the latest piece of information, which is the Feds have decided not to go ahead and raise interest rates in the month of December. Now, this is good news. This is good news for us, because the reality is we've gone through 24 months worth of roller coaster rides up and down, watching the economy kind of go back and forth, shrink, and then grow maybe a little bit and then back again. And we know that as the Federal Reserve raises interest rates, the main motivation is to bring inflation down, which it's definitely worked. Mm-hmm. But the reality is that it makes growth really, really hard for corporations, and it makes it hard just to grow the economy in general. So the fact that they have taken and not paused and raised interest rates, not twice, but now 3 times, the general consensus, Kerry, is really that this is now signaling the official pause, though I don't think we're ever going to hear them say that for a very long time. Their goal and their expectation is to try to keep a psychological lid on this economy. And so they're not going to come out. They're not going to be talking about rate cuts. Mm-hmm. Not yet, anyway. That's going to be a while. That's probably going to be in the middle of next year, I'm guessing. But good news is those interest rates aren't coming up. The second thing that I think we can look at that is a good indicator that is kind of reinforcing the decision of the Feds not to raise interest rate is the personal consumption. What we're seeing is what we all really already know, and that is that American families are not going out and buying big ticket items like they used to. What they're doing is the majority of their household income is really going to pay the utility bills. It's to buy the groceries and the gasoline. And so we see that if the personal consumption is kind of starting to kind of dim just a little bit on those big ticket items, we know that the Federal Reserve knows that what they've been doing in raising interest rates is actually helping. CPI came down. That was pretty broadly expected. Core inflation's at 4%, CPI's at 3.1%, going in the right direction. Here's a big question. Are they going to get down to the 2% like they want? And the reality is, I don't think so. And as I've contended with many of my clients across many different platforms, I don't think that they need to hit 2% for us to be comfortable at the rate of inflation as Americans. You and I have discussed this in the past. Today's generation doesn't even know what inflation is compared to what we know inflation to be from the 80s and 90s. And we don't want to have a repeat of that, of course. But the reality is that I am very pleased to see what they're doing with these rate pauses, because I think that the job is over. I don't think that they need to continue to raise rates on us.
So you think the rate raising is over, so happy days are here again, huh?
Well, again, they're going to keep a very stern set of language that's hopefully keeping that psychological lid, as I said, on the market. The thing that I think is going to be a bit of a moving target for them is if we see how the stock market is behaving right now. In fact, September was a bad month for the stock market. October was a dumpster fire. And then all of a sudden you look at November, and November things have completely changed, right? It's like the market came to life. And today the stock market is up yet again on the news of no rate increase. So now the Feds are going to be dealing with a different kind of psychology, and this is what we call the wealth effect. So even though the majority of household income in America today is now being focused more so on the actual necessities of life, when individuals are starting to see their 401ks come back, they're starting to see their IRAs and their post-tax investments starting to come back. This is going to create a bit of a psychological permission slip for Americans to say, okay, well, maybe we are out of the woods, maybe we're getting back into growth, and I can feel good about maybe taking some of my money out of my account and spending it. And so that's obviously not what the Feds want. They want to continue to see things shrink, but they're going to be contending with that wealth effect. So I think in many respects, they're also going to be watching the market very, very closely because they know how emotionally connected as Americans we are to our investments and to how much we've saved.
Okay, so what do you do now? Do you hop back in the market now that it's had this big advance, or do you play it safe?
Well, it's interesting that you say that because I've never been, as a fiduciary, I've never been a big advocate of making wholesale moves in and out of the market. I'm really more or less an advocate of being well diversified and making certain that you can take advantage of the downtimes. And we do that by keeping very, very close eye on the fundamentals, which is, okay, I want to be diversified across various different asset classes. I want to make certain, first and foremost, that I've got some safe money. I've got some money that's in fixed income. I've got some money that's in some equities and some real estate, some precious metals. I want to have that diversification because I don't know from day to day, month to month, year to year, which asset class is going to be the best performer. But I really strongly encourage people to take a look at their investments and make certain at the end of the day that they are producing at least a good 4% or better in dividends. And the reason I say that is this. It's foolhardy to believe that if, let's say you've got money in the stock market's always going to perform. We know better than that. So there's going to be times where the market isn't performing. So what if you're retired? Well, if you're retired, you need income. Do you want to be selling those shares at a loss to get that income? And the answer is obviously no. But what if your portfolio is producing, say, 4%, 5%, 6% in dividends, which, by the way, is doable? Now you've got income to spend. But what if you're on the opposite end of that teeter-totter? What if you're not yet retired? You're not even close to retirement. You're still in the accumulation stage. Well, the reality is that, many workers today, they have access to retirement programs like 401ks, 403bs, and that sort of thing. But what if the personal money that you've invested is producing that 4%, 5%, 6%, and you're using those dividend dollars to help continue the dollar cost averaging story while the market is down? And here's we all know it's almost as if we pop out of the womb and we've been told, we've already had it installed in our minds. We buy low, we sell high, right? And the reality is that if we're not producing income off from the assets that we own, doesn't mean we have to be taking it, but if we're not producing the income, then we're not able to fully take advantage of the beautiful gifts that things like this situation with the Feds raising interest rates affords us. And so we want to be able to continue to buy and stay diversified. We want to be able to make certain we're getting income. We want to make certain that we're paying attention to the distribution stage of our life if we're in that and purposefully investing for that. If we're not, if you're still in the accumulation stage of your life, let's say you're 45, you're 50, 55 years of age, and you still have 5, 10, 15 years before you get to retirement, stop playing it safe. Stop playing it safe, play it smart, and be aggressive because the market always tends to come back. We know that. We just don't know how long it'll take. And so we need to be absolutely sure to be managing our investments. Things like this is going to happen in the future. The Feds are going to make decisions in the future. We know that. It's going to affect us. Congress is going to, be a bunch of boneheads that continue to make really bad decisions from time to time, and it's going to affect the market. So we've got to be prepared for that and be agile enough within our portfolio to take advantage of it.
All right. I guess that'll have to do. So you're better off being prepared than being scared.
That's correct.
All right. Hey, well, thanks for clearing us up for that. When we have this discussion next December, where do you think things are going to be here, Matthew?
I think things are really going to be elevated by December of 2024. That's my expectation. We've gone through the ringer in the last 3 years, and I do expect good things. I think that we just have to make certain that our optimism isn't clouding our judgment and we're making rash decisions when we're supposed to just be taking a very moderate approach and doing what we are supposed to do and not being swayed with the winds of Wall Street or with the various different headlines we see. We just continue to keep our hands to that plow, be steady, be investing smartly, and making certain that you've always got your bases covered.
So what kind of returns do you think we should be shooting for in this type of market?
Well, that's a great question, because really when you read the headlines, everyone is pointing towards, look at the S&P, it's up 20%. Well, don't mistake that as 20% growth, because that's not 20% growth. That's recovery. We look at where the S&P is today compared to where it was at the end of 2020. We know that we're actually still below that high. By the end of 2024, I would like to see that we're going to be anywhere between 8 to 10%, maybe even 12% higher as an average in the S&P. I think that that's very possible if the Feds don't throw us into a recession. Is that possible? Well, it is very possible, but it really depends upon how long they choose to keep these interest rates elevated, Kerry.
Do you think we're in a recession now, or we're kind of on the cusp or on the edge?
I believe we're on the edge. I know that back in July, I was extremely nervous that they were being so very dogmatic that they were going to push us to the edge of the cliff. And man, I could look over the edge and see the bottom from where I was standing. But I don't think that we're there yet. I know, depending upon the data that you look at, some could argue that we already are in a recession. Mm-hmm. And in some sectors of the economy, Kerry, we really are.
Yeah.
But as a general whole, I don't believe that we are.
All right. Well, we won't get into China and its effect on the world, what's happening there. I think we'll just leave it here as an upbeat end of the year message from Johnson Wealth and Income to all of you out there. Matthew, just tell us, where do we find you again? Where's the best
Absolutely.
place?
They can go to the website, johnsonwim.com, or they can go to my YouTube channel, The Capitalized Life. And either which way, reach out to me. I'll be more than happy to respond.
Excellent. Hey, got a question for Matthew or myself? You can always send me an email, kl@kerrylutz.com. Link is in the show notes to this interview on our site, financialsurvivalnetwork.com. While you're there, sign up for your free newsletter. Matthew, hey, best wishes to you and yours for the holiday season and for the coming year. And we'll talk to you in 2024.
Sounds great.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.